Today, we are talking about one of the most legendary showdowns in the history of finance. It's the story of a high-stakes poker game between a whole government and one single speculator. A battle that ended with a $10 billion bet that, yes, literally broke the Bank of England. And just to set the stage, let's start with this incredible quote. It's from Stanley Druckenmiller, the guy who actually first saw the opportunity. When he went to his boss, the famous George Soros, Soros's reaction? I mean, you won't believe it. He didn't just agree with the plan. He told him to go bigger, way bigger. That tells you everything you need to know about the sheer audacity of what's about to happen.
So you have to be wondering, how did Britain get into such a vulnerable spot in the first place? Well, that brings us to our first section. You see, this whole crisis didn't just pop up out of nowhere. It started with a major political goal that ended up creating a huge, gaping vulnerability in the market.
Okay, so what was this vulnerability? It all comes down to something called the European Exchange Rate Mechanism, or the ERM. Now think of it as a way to create some stability in Europe. The idea was pretty simple. You peg your currency to the super strong, super stable German Deutschmark. For Britain, which was fighting inflation of almost 10%, this looked like a pretty smart move, a way to kind of import Germany's famous economic discipline.
All right, let's get into the nitty-gritty. On October 8, 1990, Britain joins the ERM. The rate is set at 2.95 Deutschmarks for every pound. But here's the number that really matters. That lower intervention limit, 2.778. That was the line in the sand. If the pound ever dropped to that level, the Bank of England was legally obligated to step in and defend it, no matter what it cost. It was a financial straitjacket.
And this is where the whole thing starts to unravel. The two economies were heading in completely opposite directions. The UK was stuck in a nasty recession. It desperately needed to lower its interest rates to get things moving again. But Germany was booming after reunification and needed to raise its interest rates to cool down inflation. Because Britain was shackled to the Deutschmark, it was forced to keep its own rates painfully high, which was just choking its economy.
And this whole mess is a textbook example of something economists call the policy trilemma. It's pretty simple, really. A country can have any two of these three things: a fixed exchange rate, capital flowing freely, or control over its own monetary policy. You get to pick two. Just two.
Britain? Well, they tried to have their cake and eat it too. They wanted all three, and that just fundamentally cannot work.
Okay, so you have this ticking time bomb in the global economy. Who's going to be the one to spot it? Well, that brings us to our second section, the speculator's philosophy. This wasn't just some trader looking at charts. This was about George Soros and his unique way of seeing the world, and seeing a system that wasn't just weak, but was absolutely waiting to collapse.
You see, Soros had this kind of radical idea called reflexivity. Most traditional economists think markets are rational, that they move towards some kind of stable balance. Soros said, nope, that's not how people work. He believed that our biases are perceptions. They don't just reflect reality. They actually go on to shape reality, which creates this powerful feedback loop.
And here's how he applied that idea to the pound. It's brilliant in a kind of terrifying way. First, you have the perception. The market starts to believe the pound is way overvalued and the British economy is in trouble. Then comes the action. Traders start selling the pound based on that belief. This forces the UK government into a corner. They have to raise interest rates to defend their currency. But, and here's the feedback loop, raising rates hurts the already weak economy even more, which just confirms the original perception that things were bad and invites a whole new wave of selling. It's a death spiral. And this quote, man, it just sums up his whole mindset. The situation with the pound was what traders dream of, a one-way bet. Think about it. If he was wrong and the government somehow managed to defend the peg, his fund would lose a little bit of money. But if he was right and the peg broke, the profit would be absolutely astronomical. The risk-reward was just unbelievably skewed in his favor. Who wouldn't take that bet? So the theory is sound. The logic is there. How did they actually pull it off? That takes us to section 3. This wasn't about nibbling around the edges. This was, as they said, about going for the jugular. The size of the bet is just staggering. We're talking about $10 billion. That was the estimated size of their short position against the British pound. To put that in simple terms, they were borrowing billions and billions of pounds that they didn't own and immediately selling them, all on the bet that the pound's value was about to crater and they could buy them all back later for pennies on the dollar. And you've got to understand, this was not your grandfather's investment strategy. A normal fund diversifies. They spread their money around to lower the risk. Soros did the exact opposite. They took all their chips and then borrowed a mountain more using extreme leverage and pushed it all onto one single high-conviction bet. It was the financial equivalent of a targeted assault. And they didn't just use one weapon, they brought the entire arsenal. This wasn't just about borrowing pounds. They used currency options, they used futures contracts, they shorted British government bonds, they even used complex derivatives to put pressure on the pound from every single angle you could think of.
All right, all the pieces are on the board. The bet is placed. Now, for the showdown. Section 4 brings us to the climax, September 16th, 1992, the day that would become known as Black Wednesday. This is where the unstoppable force of the market crashed head-on into the supposedly immovable object of a government's promise.
And you know what tipped the first domino? A single, seemingly harmless comment the day before. The head of Germany's central bank, Helmut Schlesinger, hinted that one or two currencies could still come under pressure. The market didn't hear a hint. They heard a giant flashing green light. They took it as a coded message. Germany was not going to step in and help Britain. The attack was on. And once the day started, it was just a total avalanche. At 8:30 in the morning, the Bank of England is already burning through hundreds of millions of pounds. By 10:30, they hike interest rates from 10% to 12%. The market barely blinks. At 2:10 in the afternoon, they try a second, truly desperate hike to 15%. The speculators just keep selling. And by 7:40 that evening, it's over. The government waves the white flag. The defense had utterly failed.
Let's just focus on that first rate hike to 12%. You'd think that would scare people off, right? Wrong. It did the exact opposite. It was like blood in the water. The market saw it as a sign of pure desperation. The government was showing its hand, and everyone could see it was a losing one.
And that move to 15%, that was so extreme, it was just unbelievable. The traders knew, they absolutely knew, that an economy already in a deep recession could never survive a 15% interest rate. It was a bluff, and a really bad one. The market called it in a nanosecond. So it's a total disaster, right? The government is humiliated, billions have been lost, the pound has crashed. Well, here's where the story takes a really unexpected turn. Section 5, the golden aftermath. Because this national humiliation had a surprisingly positive legacy. Okay, let's look at the immediate scoreboard from that day. On one side, you have the British taxpayer, left with a realized loss of £3.3 billion. And on the other side, Soros' quantum fund, walking away with an estimated profit of $1 billion, one of the single greatest trades in history. The second the government gave up and unpegged the pound, this is what happened. It just fell off a cliff, down 15% against the German Deutschmark and a whopping 25% against the US dollar. But, and this is the crazy part, that Black Wednesday almost immediately started being called Golden Wednesday. Why? Because leaving that straitjacket meant Britain could finally do what its economy needed. It could slash interest rates. The newly cheap pound made British exports boom, and far from causing a disaster, it kicked off a long period of strong, healthy growth. Which leaves us with the big question, the one people still argue about today. Did George Soros and his $10 billion bet really break the Bank of England? Or was the system so flawed, so fragile, and so full of contradictions that all he really did was give it a little push and watch it crumble all on its own?